How is everyone doing? Hey, guys, so I want to apologize for our sudden cancellation. The snow, we did not want our employees staying late with the snow coming down and everyone having to come home. Plus, we figure people didn't want to be driving around in this snow and ice, so we will be doing remote today. I do sincerely apologize. We like to meet everyone in person, so I want to make sure that you guys hopefully we'll all come in and meet us in person for our next class. That will be in January. If not, after this, we'll be reaching out to you guys and trying to reach out and have you come in for some one-on-ones and talk to you guys a little bit more. Um, um, so we're just making sure everything is working correctly. And then we are going to get going in about 1 minute. Also, guys, there's a chat box inside this at Restream. So if you type in any questions throughout the presentation, what I think works really well is if you just fire in questions throughout the presentation, and then I will answer all of them at the very end. It could be about the presentation, or we can talk about anything real estate related. So if you have any questions about what's going on inside your market, what you guys are doing, I'm more than happy to talk about that as well. This is not just a presentation about who we are as a company. We want to make sure that you guys are getting any kind of other questions answered, because obviously there's been a lot of shakeup in the market. So we're going to get going right now because we have a lot to cover. So I think everyone is still kind of rolling in, but there will be a recorded version of this as well. So if you missed anything, you can have access to that. So welcome to the Investor 101, presented by Heaton Dainard and Intrust Funding. To give you guys a quick background for those who don't know us, Will is my business partner. He primarily runs Intrust Funding and a lot of our development stuff. But to give you a background on the two owners, and this is primarily why people really enjoy working with Heaton Dainard, or we have a high client repeat basis, is because we are not just salespeople. We are not just lenders. We are not just brokers trying to sell that next deal. We are active investors. Currently right now, I think we have roughly about $20 to $30 million in our pipeline right now of value that we are working on. And so we're very active guys, and that's what we sell. We sell what works with us, and those are the plans that we put together is what is going and how we kind of look at deals. So when you're looking at any deal, it's kind of how me or Will would be doing these projects. And so that is kind of the backbone of our company. So Will has been, he's got over 10 years of experience in the multifamily and residential real estate. He has a very extensive background in development and rehabilitation and renovation. Primarily what Will works on more is the townhomes, our single family, and the new construction. And he works with Intrust Funding on underwriting the deals, making sure the loans are safe, and getting you guys your funds very quickly. He is kind of the shot caller over there. With myself, I've been an active investor since 2000 and shoot, I'm getting old now. 2005, the end of 2005, I started off as a door knocker for a local real estate investment company. We started wholesaling a lot of properties, and then as the market crashed. And the properties, as the market crashed, the market transitioned, where we kind of became really active investors in 2008 is a lot of people didn't want to buy real estate at the time, and we had all these good opportunities. And so we ended up buying a lot of properties in 2008, 9, and 10, renovating them, selling, or keeping them as BRRRR style properties. And what this did is it gave us that experience to really help our clients consult with what to do, what not to do in properties, and to try to help you guys make it to financial freedom or rack that next return on that next deal. I have led our we have at Heaton Dainard, we have done over $1 billion in real estate investment transactions. There's a little old stat in here. It says led team to over 67 million in sales volume in 2017. We might have the wrong presentation up on that slide, but since in the last couple of years, we're typically on average, we're doing about 100 to $150 million a year in deals with our local client base, where we are finding the acquisition, we're helping them with the renovation, we're helping consult, we're getting them referrals and design, and then our sales team has listed and sold over 1,000 properties on the market and done over $1 billion in sales. So we're very, very active brokerage. So since 2010, like I kind of briefly talked about, we have sold over 3,500 properties to investors just like yourselves. We've done over $1 billion in transaction volume, and we have helped investors design and sell over 1,500 homes. And so we are very active shop. We have lots of experience, lots of good experience, and lots of bad experience. But whatever it is, that teaches us a lesson to help our clients through the next market. Heaton Dainard Real Estate is a brokerage. We're a very boutique shop in our local market. We're not one of the big companies. We're not Windermere. We're not Keller Williams. We're not John L. Scott. We are designed for investors just like yourself. That is the backbone to our company. We're not your retail shop that's going to go out and work with a lot of traditional home buyers. We work with investors. You are our clients, and we have built our whole business around you guys. So what do we do? Off market properties for investors, whether it's a fix and flip property, it could be a burr property, multifamily, whatever you're looking for, we're going to look for that deal. We don't really care where it comes from, but then we're going to help you secure that deal and then help you with the property analysis. So what is the property analysis? That is whether it's a fix and flip, we're going to run your hold times, your rehab costs, and we're going to talk about this more later in the presentation. But we're going to go through what we think is highest and best use for that property, whether you should keep it, sell it, or maybe keep it for a year or two and then sell it and trade it out later. But we're going to give you all the analysis. We're going to pull the rent comparables, the value comparables, and then we're going to look at all the different the renovation scope and what you need to do and what you don't need to do with the property. And then once you purchase that property, our team is set up to help you all the way through that process. Now, we are not general contractors and we are not project managers, but we're going to get you referrals to contractors, subcontractors, people that you need to help you with executing that plan. And what we're really known for is our design skill with our talented broker team. And again, we'll talk about that a little bit more in our presentation, but we're going to help you all the way through that process of what to do, what not to do, what fixtures to put in, what design to put in, how not to overspend or when to overspend, and help you get that property stabilized. Because at the end of the day, we are buying value add opportunities, which these need the right plan to be put on each one of these houses, and they have to be executed well. You can buy the best deal in the world and you can mess it up. I have done that numerous times over my life where I bought something really cheap. It was a good buy for cents on the dollars. And then I had the wrong plan and everything went awry. And it ends up costing me thousands of dollars. I mean, shoot, we just learned a pretty tough lesson on a property 4 months ago that we took a nasty hit on. There was numerous factors in there. It was that we put the wrong plan on it, and initially we had to scrap that plan, restart it, and then with the time, the debt costs, and then with the market correction, it ended up being kind of a loss. So putting that right plan in place is very, very key to this real estate journey. It is not always about the buy. It starts with the buy. You have to get the right property, but it's about how you execute on that buy, which is going to dictate how much money you're making or how much wealth you're building in your rental acquisitions. So what we're going to help any of our clients, or what we help clients do, is we're going to help you with the acquisition and the purchasing. We're going to secure that deal. We're going to underwrite that property for you. What is highest and best use? What are rents? What does the rehab plan look like? What are the fixed up values? Then we're going to get you contractor referrals to help you with that process. Now, each one of our clients usually have their own construction team, but what we're here to do is help plug in different types of subs, like whether it's a roofer, a painter, a cabinet install. So we're here to help you kind of drive those costs down. And then we're going to get you financing referrals, like we work with Intrust funding, to where you can get that deal funded very quickly. But then if you want to keep it, whether it's a multifamily commercial loan or your or your burr property, we're going to get you in touch with numerous different financing options so you can explore those options and get that property secured with permanent debt. And then we are going to help you with the design services, which are all included in our listing fee, or even a lot of our multifamily broker will help you with that design and get you the templates you need to stabilize that property. So let's talk about getting started. What does it look like? So before you get started in any real estate investing, it is essential that you build the right team around you. Give you guys a quick story. When I was a wholesaler, I started flipping condos, and it's really easy for me to do. I could do carpet, paint, appliances, put it back to market, or keep it as a rental. It was simple. But once I bought that deal that needed a lot of different work and I didn't have the right team around me, I was a wholesaler that had a lot of deal flow and had access to what I was doing, but not in the fix and flip space. Because I had the wrong team around me, the deal went terrible, and I ended up losing a ton of money. If I would have had the right bench around me, I could have cut my costs down by at least 50%. In addition to, I could have actually got in and out of the deal a lot quicker. But when I bought it, I had one friend that was a general contractor. I went with him, and it just went terribly wrong. We went double over budget. We went double over our timeline. And then that was in 2008 when the market crashed and I got squeezed on my numbers and I got wiped out. So, how do you prevent that? You have the right bench. You need two reliable contractors. That is key, right? You always want to have two general contractors that you've met that have worked with investors. You want to have two reliable subcontractors. You need to have a dependable hard money lender like Intrust Funding that can fund that good deal when that opportunity arises. Even though the market has kind of staled out a little bit, the good buys are still moving very, very quickly. So if you're not prepared with that hard money lender, you could miss that good potential deal. And then in addition to having a hard money lender, you need to make sure that you have a conventional lender and a commercial lender also on your bench. This is going to be key for you, anybody that wants to keep property, or if you're fix and flipping, you want to know what you can or can't do on your exit strategies. That conventional lender and commercial lender are going to help dictate whether if you can only buy fix and flip and you have to sell it, or if the market isn't quite going the way it's gone the last 24 months and we're seeing a little bit of a slowdown, you might want to keep the property for a longer term. You want to know that you have the ability to get in and out of that loan. Not every lender can work with investors, or they all say they can, but you want to find the right mortgage companies that know how to get you in and out of the loans, that you can refinance the properties, and they understand what you're doing as an investor. So, and we will get you guys all those referrals when you come in and meet with us. So we're going to get you usually typically 3 referrals to conventional lenders and 3 referrals to commercial lenders, or just a commercial broker that can help get you that lending. Um, um, So pre-qualification. So this is very key before you get started too, guys, because one thing that you want to do, like right now, what we've seen is we've seen actually a market shift over the last 6 months. Now, that doesn't mean that the market's always shifting down and you have to move things around, because what we've seen is the pricings came down with interest rates and now it's kind of starting to flatten out. A lot of the properties have already made their adjustments, but if you're an investor and those adjustments have came down a little bit further than you want to be able to refinance that property and keep it for the next market cycle or weather this 12-month storm that we're working on. So pre-qualification is going to help you get through that process. You want to make sure that you can not miss that deal and that you can also be safe in that. So by getting pre-qualified, it's going to tell you what kind of deal you can buy, how quickly you can fund it, how you can make a quick decision, because you don't want to buy something that you know you can't get the money for. So by being pre-qualified, you know what you can buy or can't buy. And then you know you have the takedown financing, which is the conventional or permanent financing that can get you in and out of those loans. And that is very, very key. So before you buy any investment property, not just any type of fix, not just even from us, get pre-qualified, know what kind of access to capital you have. I've seen investors do this too, where they go in and they commit to a deal. They were talking to a lender and they thought they had a lot lower down payment, but they weren't fully pre-qualified. And then they come in to close and the lender's asking for substantially more money and they would have passed on that deal. So you want to make sure what your terms are, who can fund it, and how quickly you can do. So now that we talked about getting started, we're going to talk about what we do at our company and the team behind that's going to help you through that process. So our job at Heaton Dainard is to find you the best possible deal that you're looking for that meets your buying requirement and also meets your skill set. Your job as an investor is to execute it, but our team is designed to help you all the way through that process. So how our fix and flip team is set up is we have over 100 years of experience between our team, including myself. We have 4 acquisition brokers that work in specific counties right now, and they are tracking all the deals that are coming on market. In addition to all our off-market deal flow from whatever marketing that we have going on, they're going to look at every deal and scrub those before they actually come to you guys. So we are already prepping these sellers for where the numbers need to be. Um, they're also going to help you secure that deal, meet with you, find out what's in your buy box, help you narrow that buy box down, and then bring you opportunities that fit inside that buy box. In addition to, they're going to run the comps, the analysis for you, the rent cash flow, and they're also going to look at what's the after repaired value and give you that pro forma on whether it's profitable or not. Our support staff that helps all of our team, it's not just us. We have 2 full-time transaction coordinators and a full-time assistant that helps our clients all the way through. Our listing team is designed with 4 different brokers. Now, these brokers, you guys, are not like your normal listing brokers. Every one of these brokers have listed and sold a property for myself. They are not just brokers. They're going to put a sign in the R, feed the offers, or work on generating offers. They are going to work with you all the way through the process from when you purchase that property. They are design trained. They know how to pick colors, they know how to pick themes, they know how to source cabinets, they know how to source flooring, and they're here to help you make sure that your property is in the best possible shape to get you the highest possible dollar. In addition to, as you're going through your construction process, we have Ryan Burgess, who has worked with us for over 10 years at our business as one of my project managers. He is our client service manager at our office. So what Ryan's here to do is he is constantly tracking down new contractors, vetting them, talking to them, looking at their work. In addition to, as you buy that project, whether it's a BRRRR, fix and flip, or apartment, and as you have construction issues or questions, Ryan is a resource for you to call, and he will walk your property with you, see what you're looking at with your contractor, give you some recommendations. And if you need referrals for contractors to help reduce the cost, he's going to be your guy to get you those. So you have a full team that's going to surround you to help you execute that right plan. Our goal is to get you all the tools to be successful and the extensive resources to guide you from start to finish, but it is your job to execute this plan. Our team is going to help you get there, but at the end of the day, you are the investor, and before you buy that property, you need to make sure that you can be accountable and get through that project. This is not an easy business, guys. Before we kind of jump into acquisition, this is a tough business. It is very, very rewarding, though. If I look at where I started, I mean, I started in this business when I was part-time waiter at Red Robin. How I got to where I am now is by executing the right plans and staying on top of my business. This is not something that you can just go buy, hire a contractor, and voila, it's all done. As a business owner, and that's what you're doing, this is a real estate investment business, you have to manage that business. Our team is here to help you manage that business. So let's talk about acquisitions. So I know for the last 24 or 28 months, it's been really hard to get a deal. And actually in today's market, even though the market's flat, it's even harder. The reason I say it's even harder is because there's very few actual opportunities out there. There's a lot of pricing that's still pretty high. The numbers aren't going to work. There's not enough risk factors or risk mitigation factors in each deal to where investors don't want to pull the trigger. But what our team does is they're going to bring you actual opportunities. We're not just going to be showing you listings. We're going to show you a property that we've secured under contract, what the number is. We're going to run an estimated rehab plan for you, and then give you all the values behind that. So every deal you get from us is an actual fixed opportunity pricing. The pricing doesn't go up, it doesn't go down. I know there's a lot of wholesalers out there right now that they'll put on their asking price. We are not asking price guys. We've already scrubbed this deal. We know the numbers work. And at the end of the day, the pricing doesn't go up or down. The only time it has happened where it's gone up is because we've actually had a client commit to a deal. They brought in their cashier's check, and another client wanted it that bad that he actually offered that client money to walk away from the deal, but we will never take that price. And then what they're also going to be doing is helping you with the analysis overview. So in the analysis overview would be and they send you opportunity, they're going to send you their walkthrough notes. What did they see at the property? They're going to run a deal pro forma, and we'll look at that in a second. What is the financial performance of the property? What's the exit strategy? What do we think is highest and best for the specific investment? Is it keep it? Is it sell it? Do you want to keep it for a year or two and then trade it into something else? But we're going to go through all those strategies with you. And then we're going to give you a spec with it based on our exit strategy of what we think you should do with a rehab plan and the design to back it up. And then we're always going to produce the CMA and comparables for how we came up with those analytics for that property. Now that we've talked about the acquisition team, let's talk about the listing services. So our listing team, and I've already kind of mentioned this, is designed and budgeted trained. They are up to date with all the latest trends, and they know this because we sell so many properties in Kingston, Homebush, and Pierce County. That's our primary core markets. Because we have properties in all different ranges, anywhere between 300,000 up to 5 million, we know what the buyers are looking for, what trades, what doesn't trades, and they are constantly updating these designs to help get you the highest and best number for your property or get you the highest rent. In addition to this, our listing team likes to keep you guys in tune with what's going on. They're going to get you up-to-date market updates. So when you buy that property, they're going to put you in an auto search showing you what comparable properties are selling for. As you fix and flip these properties, things can change over a 6-month period. You want to be up to date on what's going on. Did the property value go up? Did it go down? Should you be spending less money? Should you be spending more? So these market updates are going to be very, very key, and you're going to see them in real time as they get listed, go pending, and sell, so we can see what they're doing. Once we see those data points, if there is a major change, they'll meet you at the property. We can walk through it and see what we can do to switch the plan up. They're available for monthly or weekly job site walks. So basically, our brokers, once you buy that deal, will walk that property whenever you want. In addition to, they're going to work side by side with the client service manager, Ryan. So if you have issues, they're going to look at it. Let's say there's some cost overruns. They're going to maybe look at different specs and keep that cost down. In addition to, they can provide you with the CMA and comparable whenever property, during the property, or during when you're getting ready to list it. So knowing your deal, fix and flip property. So we're going to dive straight into how do we look at deals and how they're sold, because that is the best way that we can show you how we do business. In addition to, guys, one thing I want to also mention, I know a lot of people kind of came in late. If you have any questions during this, go ahead and just fire them in that chat box, and I will get to them at the end of the presentation. So when you sign up with Heaton Dainard, you're going to come in, you're going to do your one-on-one. We're going to kind of figure out your buy box, and then you're going to start receiving deals just like this, or in a way that could just be a simple Outlook message, but it's always going to have that core information. So as you can see, this is like the sample of what a deal that we sold very recently in roughly the last 12 months. So as you can see in this, it has everything that you need to know. It's going to give you a little snapshot over here of what the property is, the area, just a general background of the geographical location. And then in addition to, you're going to see the nuts and bolts to what it is. So under acquisition price, this property was $410,000. The estimated rehab was $130,000, and the estimated ARV was at $699,950. The estimated profit on this deal was at about $100,000 without factoring leverage in there. The reason we put that in is because a lot of our clients do pay cash, some borrow, but we're going to back that up with the performance. So as you go through, you see these two boxes. You're going to see click the link for photos. We'll go to that in a second. But if you click that, that's going to bring you up anywhere between 50 to 100 photos. What we want to do and what we pride ourselves on is people's time. If we're sending you this deal, we're going to over put in the information so you don't get in your car, drive. Let's say you're in Bellevue, you got to drive all the way down to Tacoma just for you to get there and be like, wow, this is not for me. It maybe be a good deal, but it just might not be good for you. So we're going to give you a ton of photos so you can really look at that property before you go out there and look at it. Then the next button you're going to click is the Performa, and that's going to bring you through the financial performance of the deal. We'll look at that in a second. And then we're going to give you a bullet points of what we roughly think needs to be done to this property, to just give you a quick snapshot. Again, we are trying not to waste your time. And so in this email, we're going to give you a summary of what the price is, what the estimated rehab is, what the value is, the performa, and then a quick snapshot into what the rehab is. So as you can see, you can go through these photos. It kind of gives it a picture. So this house was actually not that bad compared to some of the properties we sell, but it was like an old estate home. It had some things done, like part of the windows have been updated, and it was actually somewhat rent ready. If if it got a coat of paint, throw some new flooring down, it could have been rental in this specific neighborhood. Probably want to do some flooring down here, some carpet, or refinish out the hardwoods. But that's not what the intention was when this client bought this. They were doing a fix and flip. And so the reason we had $130,000 budget in there, even though a lot of things were good, like the roof was good, the windows were good, what we did know is all the systems were old. They had old plumbing, old HVAC, old electrical. And so we accounted for all those inside those walls. And actually the basement had been kind of redone into a man cave. Back deck wasn't so bad. But as you can see, it wasn't like a terrible property, but it needed love to optimize out the value. So once you go through the photos and you go, okay, this looks like a buy. I'm okay with this scope of work. I got 130 grand. I get to look at the property. It's not too scary. My guys have done this before, or I got a contractor that can work on this. And then Ryan's there to help you with the referrals. Then you can click onto the perform on the deal, and that's going to show you the metrics behind what the property is. And so as you see in that top box, it says total acquisition. So that's the purchase price, $410,000. Fix up at $130,000 with the ARV at $699,950. And then under estimated hold times, that's where it says 9 months. That's where we are factoring in 9 months of hard money costs into this deal. Typically, on average, for cosmetics, we factor 5 to 6 months on each property. We have increased and added about a month to a month and a half to each one of these deals to account for the longer market times. As we know, the market has kind of slowed down and things are no longer selling in the first 5 days. On average, our listings are selling in about 36 days that aren't excluding the pre-sale properties we have going on, because those are a little bit of a slow mover. So the reason we added in that 30 to 45 days is because that's what we're experiencing across all of our markets. A lot of our properties still sell in the first 2 weeks, but on average, they're taking 30 to 45 days. And so we've kind of added that into the pro forma. So on this specific deal, though, we had 9 months of hold times, which is going to factor everything in here. Now, these 3 boxes are set up for 3 different types of purchase. The first one is for a cash purchase, and that's where the investor has the 410 to purchase, the 130 in rehab costs, and their total project cost is 545,000. We added in an additional 2,500 for miscellaneous, which is going to cover your utilities and just general hold costs. And then we have the value at 699, backing out all the sale costs, excise tax, title, and escrow, and the estimated profit was 100,443. But the cash on cash return was at 18.5, which is actually a great cash on cash return deal. The issue with that, though, is you have to have $545,000 to do that deal. I know as an investor for myself, I'm not sitting on that much cash typically at a time. The reason being is I use leverage to maximize out my portfolio, and we'll talk about that a little bit more in these next 2 boxes. The next 2 boxes are loans that have been 100% pre-qualified with Intrust funding. So they offer numerous different types of loan products, but we know that these 2 have already been approved for this deal. So the first one is as a standard 20% down. That's where you're going to come in with 20% down at the 410, and then you're going to fund that 131,000 out of pocket. Which ends up being, on this deal, you're going to come up with about $245,000 with the 20% down, the rehab, and the carry costs. The reason some people do this, and this is kind of a rare loan because most people just want to build in the construction component, is they might just be sitting on excess capital and they don't want to pay lending costs on money that's going to sit there already. So if you are extra liquid, you might want to go this route. Majority of the investors are trying to work their money to highest and best use, right? Time value money. How much cash do I have? What can I put it in? And how much will that come back to me at? And what is the highest possible return? I do construction loans on almost every one of the projects that I do. Unless I'm like sitting super flush on cash, I might pay cash for it for a 3 to 4 month period and then refinance with Intrust funding to pull out my cash and then start the project at that point. I do that to kind of prevent extra debt costs. But majority of the times, I'm just setting it up with a construction loan. And that's typically going to be 20 to 25% down of the total project cost. So that's where Intrust funding is going to finance you the 410 plus the 130. And you're going to come in with 20 to 25% down, which on this deal was $135,000 down. But they're going to finance you the $130,000 back. So let's talk about that for a second. On this deal, they're putting 136 up and they're getting 131 back to reno that property. So as you can see, they're getting a lot more leverage on this deal, which is going to increase their returns dramatically. The one negative of this is you're going to be paying lending costs on the higher loan amount. But it's going to increase your return. So on the 20% down after all costs, they were looking at a $58,000 profit return. On the construction loan, because you're borrowing about roughly another $80,000 on this deal, the profit actually goes down to about 49,000. So that's a difference of $10,000 in profit because they decided to leverage. But the main difference is the investor had to come out of pocket with 175 with the construction loan or 250 with the standard 20% loan. And the investor with the construction loan is actually making a 28.3% return rather than a 23%. So they're getting a better leverage return on that. And so as an investor, I'm always looking for what is highest and best use. What can I get the highest return on? Because I want to keep as much capital on hand to do as many deals as I can. I would be rather racking, like in this scenario, let's say I had 545,000 like this investor had for cash. I can now do this deal almost 3 times over by using this leverage with the construction loan. With the 20% down, I can only do 2 deals. So if I'm looking at leveraging with the construction loan, I'm looking at doing $150,000 in profit in the same time period as this investor is making $100,000. In addition to, I'm making $150,000 profit with the construction loan in the same amount of time if I'm doing 3 deals, rather than the $116,000 of profit that someone could do with 20% down. So again, always think about what capital you have, what gunpowder you have, and what is the best way to work it. Now, if you're a new investor, I do not suggest that you go buy a bunch of deals and go put leverage on them all. You want to buy that first one, work through the system, work through the kinks, work with our team, use a little bit less leverage, and then start expanding out. Because once you have that team, it makes it a lot easier to scale rather than just going out and buying everything. That can be a dangerous, dangerous thing. If you start buying too many things you don't know really how to stabilize, it can get you in a lot of trouble. So after you go through the pictures, you like the pictures, you like the numbers that meet your expectation returns, then what you're going to be able to do is click on the design book. So we have 12 different flip books for 4 different styles of homes that are common in the local Tri-County area. The reason we have 12 different versions of 4 different styles is because each style has its own budget range. So, for example, in a Craftsman home, we're going to have a more budget-friendly one that's a more cosmetic turn. That might have cheaper flooring, cheaper appliances, and just a little bit simpler. Then we have something called economy, where you're doing a little bit more work and you're spending a little bit more. And then we have a premium and a luxury. So what the big difference in this isn't a change in who's doing the work and the allowances that are set for the rough-ins and the trades. It has to do more with the material allowances. For example, in a luxury home, our light fixtures might be an average of $250 a fixture, or even our dining right could be a couple $1,000. Whereas in our budget flip, we might be spending $15 a fixture and $100 on the dining room fixture. So that's a big swing in different specs. But at the end of the day, the electrician installing that's still going to be the same price. He's still going to charge me $50 to put it up in the ceiling. And so it has to do more with allowances. But these flip books are going to be top selling design trends. We know what's working and what's not working. And also, you guys, for 2023, we're actually going to release about 40 of these. We're going to take all the different customizations that our 4 talented brokers did. We're going to put them all into a spec sheet, and you're going to be able to pick and choose whatever specs you want for your specific house. So you're going to have numerous different ones to work on it. But it's going to guide you with all the top selling trends, the colors and finish themes, and designs for any type of budget. So it's going to really help your project be cohesive, and cohesive helps it sell for more. So once you go through the spec sheet, then you're going to go, what is going on with the budget? So how did we come up with that $130,000? And you guys, I have a ton of people sending me deals on the regular, and there's nothing wrong with the deals, but they put a rehab number on it that might not work for me. And so what we do is when we're putting in that $130,000, you as an investor need to verify that's achievable for you to do it under that cost. But we are going to back it up with a rough calculation of how we came up with that number. We're not just ballparking it. And we're going to go through that in a second. So in this budget breakdown, we're going to give you rough calculations of costs. We're going to give you budgets that are based on historical race. We're going to give you budget breakdown for by allowances and install rates. So how do we come up with these numbers? And then, like I said, all investors need to verify their own costs. My costs are not yours. Yours are not mine. A lot of my investors, especially my Pierce County guys, they can actually turn a property a lot cheaper than me because they're a little bit more hands-on. Now, some of my tech clients, they might spend a little bit more on me, and that's okay, but we need to account for that in the numbers, and we can put that in the pro forma for you. If you think it's going to be 150 and we're at 130, that's totally fine. We will put that in the pro forma, then look at the deal that way, and if it doesn't work for you, move on to the next one. And then, like I was just talking about, investors should adjust their performance accordingly. Because again, you guys, none of our costs are all the same. So, anytime I'm looking at a deal, I mean, even me and Will, like when we're looking at 2 projects, he might look at it one way, I'm going to look at it a different way. And that, again, there's no right way to do it. It's what I'm good at and what he's good at. He might spend a little bit more money and go a little bit more luxury on it. I might do it a little more budget friendly. And so as an investor, you just have to know those things. So this sheet right here is our construction calculator. And you guys, I actually have something very special I'm working on for 2023 right now. We are ramping this thing up and improving this. It's a big undertaking, so I'm in the process of doing it. We're hoping to have in the next 4 months that this actually calculator is going to turn into a rough scheduler for you, an allowance breakdown page to where you can adjust your allowances really quick if you're spending or not spending, and will adjust your budget live. And this will be free for all the Heaton Dainard clients. And if you're not Heaton Dainard clients, it will be for sale on Project RE. So be on the lookout for that. So what this does is you can see though, like for example, on electrical that you're looking at, this tells you how we come up with our numbers. So we had at a rewire, we had 2,000 square feet. The house is 2,000 square feet in size. We had $3 a square foot just to rough in the Romex. That works for a lot of the electricians that we know locally, and we will refer you out. But if they're busy, they might charge more. So you need to also know how much your electrician is going to charge. And you guys, sorry, I got a little bit of a cough too. That was another reason I kind of didn't want the meeting going on. We had snowstorms, people sick, tight quarters, probably not a good mix. Uh, but and then as you can see from here, it goes 2,000 for the rough-in. Then we had $2,000 for the trim out, and then have broken down. We had 14 ceiling mount fixtures to go in there. We had an allowance of $20 a light fixture and $25 for them to install each one of those lights. Ceiling mount fixtures, we had one in there. But as you can see, it's broken down by install rate and allowances. So we give you a very tangible roadmap that you can kind of look through. You can print it out with your contractor and then go through them all. Again, kind of verify those costs for yourself. Now, once you've gone through the pictures, you like the deal, you like the numbers on the metrics, you looked at the rehab plan, you say, I can work with that. Then we're going to break down those comparables. So our brokers will always be sending you the links to these properties, what they were, when they sold for. And typically right now, you guys, with the market cooling down, we've been staying very tight on our comparables. We are only using 60 days or newer comparables and pending comps. So even if we have good sold comps that are 45 days ago, but the pendings are trending a little bit lower, we're going to reduce that value down. One thing I can't say is we have analyzed thousands of properties. We have fixed and sold hundreds of properties during a really bad downturn in 2008, 9, and 10. That's how we got very good at underwriting properties and building a risk to these deals. So you're not going to see our properties pushed to that max value right now because that's not what the market's dictating. About 12 months ago, everyone was chasing that high comp because that's what it was doing. It was appreciating at 5-10% a quarter. And so the properties were going up rapidly. Now we're being very conservative and staying with the trend. I do feel like many of the neighborhoods that we've been working in have kind of gotten to these like little, I don't want to call them bottom, but they've kind of gotten into the affordability range. I mean, a good example of that is I was talking to two brokers that we've had a property on market now for, man, I think it's close to 70 days, and we're priced, and now we have 2 offers coming in right now. And so, we did 1 price correction, and now we have 2 offers coming in. And so the market's kinda at where it's at right now to kinda generate activity. It's not as dead as what made people think. It's just pricing is really important. But in these comparables, you're gonna be able to go through them, click through the links, go through all the photos, see what they look like, what they had, and then you can really look at the rehab and go, "Okay, is this matching up with what I can do?" And then once the property's done, it's going to look a little bit something like this. So you guys, all these finishes in this property were all picked by our brokers in the office. This is actually a pretty hands-off client, and they relied tremendously on our design work. But as you can see, it got all the paint colors were selected. It probably turned out really good. Very good curb appeal, nice Tudor property. All the flooring got updated. I know Megan helped design this one, and she had them stain out this beam that they installed instead of just wrapping it with MDF to give it a little bit of character. We ended up trenching, as you can see. She had them keep, we had in the budget to take a lot of stuff down to studs, but you can see that the plaster was actually all trenched in because she wanted to keep that original charm. And that's what these brokers are so good at doing is, investors, like, especially for me, I want to turn these properties and I have templates I work off of, but these brokers are going to help add in that little extra detail that makes someone fall in love with the property. And in this current market, that is fundamentally important. You don't want to be one of the masses. You want to stick out a little bit, but not blow your budget. So you can see the bathrooms are all redone. We did all subway tile because it was more craftsman home. Mirrors were selected by our brokers, all inside budget, and you can see how it turned out. But it was a killer house. Basement, man cave stayed, and then most importantly, not how did it turn out, but what was the math? So they paid 410 for it. They put 130,000 in this property. Um, we had a value of 699 to 720, and it ended up selling for $800,000 with a net profit of 71,685, which ended up being a 45% cash on cash return. So as you can see, the market had it's by using if they would have done all cash on that deal, their return would have been more like around 24%, but instead they almost got a 50% return in a 9-month period. So, annually, that's going to be about a 70% return. In addition to, that's a real deal, guys. That email was blasted out to all of our clients. Our client took it right away. We try to pride ourselves on conservative underwriting. Now, I know over this last 9 months, it's been a lot trickier because obviously the market has compressed down, but now it's very easy for us to operate. And you guys, I prefer to work in a flat market. That is how investors should be working. This high appreciated market was not a real thing. That was anybody could buy anything. If anybody bought a fix and flip property or any kind of house, that thing went up in value. So now what you have to do is get good at executing the plan as long as your underwriting is correct. So steps we're doing to be conservative, again, we're using 30 to 60-day comparables. We are adding contingencies to our rehab plans for you guys, and we are adding in an extra 30 to 60 days in the whole cost to kind of account for all the longer market times. As long as you build all these costs into the pro forma, you can still make a really good return. In addition to, we're seeing better buys than we've seen in the last 24 months. Considerably better buys. I know personally, me and Will have purchased. We've bought a lot of stuff in the last 60 days. Oh man, I think we purchased nearly just ourselves. We've purchased nearly 18 to 19 million dollars in deals. I would not be spending that kind of money if we weren't comfortable with what's going on in the market or we weren't comfortable in the underwriting. So as long as you underwrite, any market is doable. It's actually a better thing to do because right now, you guys also too, over the last 24 months, we were buying deals at like 15% cash on cash, which is equating out to about that was equating out to about roughly about a total 30 to 32% cash on, or 25 to 32% cash on cash return. Now we're getting deals at 18 to 20% returns, which is going to equate out to about a 35 to 40% cash on cash return on many deals. And so the walk-in margins are bigger and we're being more conservative. So other deals that have been done over this last year, and we're going to update these all for the new year. A client purchased a property for 585. They put 85 in and sold it for 850. Andy Hughes, who's on this right now, he just loves coming to my classes. Andy, we gotta get lunch. I'm gonna take you out to lunch at the beginning of the year. Andy's a great client of ours, and actually, this is his property. He paid 380 for it. We estimated 105. I think he put about 140 into that one, and he sold it for 650. Good deal. 380. I mean, honestly, that price, the house is so low, we could have tore that down and built that. Another deal we did was 850, $250,000 in renovation. The client sold it for 1433. And another cheap deal where they paid 200 and they put 130 into it. It was a massive fixer and they sold it for 550. So as you guys can see, the numbers and the profit potential change quite a bit in what you're buying. Even this deal at 200,000 with 130 in renovation costs, this house was only 750 square feet, if I remember right. That was a big budget, but it was absolutely hammered. So the bigger the fixer, the better the deal. If you have that skill set and you have that construction resource, you're really going to be able to get through and get good buys. So long-term wealth, knowing your cash flow property. So now that we've talked about the fix and flip, and again, you guys, if you have any questions about fix and flip, fire the questions in the chat box. I will answer them. Now we're going to talk about the meat and potatoes of real estate, long-term wealth, how to keep them. A lot of people know me and Will as the fix and flip guys, developers, and that is all true. What we do with that profit is we buy more holdings. Locally, we have nearly 1,500 doors in King, Snohomish, and Pierce County. We're very active buy and hold investors. Not only are we active, it is what has changed everything for us over a 10-year period. And it doesn't matter when you buy them. A lot of the properties that we bought that got our whole portfolio spring-loaded and pushed forward was during the time where no one wanted to buy rental properties. I can tell you in 2008 and 9, not a lot of people were looking. And so we were able to buy properties just like right now. We've bought more properties in the last 60 days for holds than we did in the last 2 years combined because there's good opportunities out there. So our long-term wealth, what we sell and what we're I think good at underwriting is single-family homes, multifamily, rooming houses. We do sell some commercial if you're looking for that. Vacation rentals, we have a small background on that. We do a lot of analytics for clients that want an option for the rentals. One thing I want to say about short-term rentals is that market's kind of compressing back quite a bit right now. I personally will only buy a rental property based on normal rent metrics. Short-term rental is just an add-on to your return. It's more work. It takes more, it's a little bit more inconsistent, but typically your average returns are going to be substantially higher. But don't buy a deal based on vacation rental numbers. Buy it on traditional rental numbers. Buy it, even if it's your bare bone. Let's say you're trying to make a 7% return on your money and the deal's making 6.5 to 7%. So that works. Buy that one and then add the short-term rental to that and then make your return. And then also we do syndication. If anybody who's accredited is interested, you can invest with us. Um, so why holdings? Well, the tax benefits are good. I pay 40% taxes as ordinary income on my flips. That is a high amount. If I keep the properties, it's not the same. It's at a 20% after a gain. But primarily what I'm using it for isn't just for the tax benefit. Well, no, that's not true. The tax benefit, I actually invest in our own syndications to get the depreciation and cost seg back on a tax benefit plus the return. In addition to, if you're buying multifamily properties, you can cost segregate that property, depreciate it more quicker, and get that money back to you at the end of your year in your tax return. Many investors I know, smarter than me, because I probably should have been doing this even more over the last 10 years, is they would depreciate quite a bit of assets and always buy. I know a good buddy of mine I met at a mastermind through Bigger Pockets, but it was he says he buys an apartment building every year just for the depreciation and to bring back his taxes. So there's huge power in keeping them. It's a great hedge against inflation. If you guys can buy something that's making you a 7, 8, 9% return cash on a rental property, plus get the appreciation out of it, doesn't care what your rate is. If you're making that return, you're beating inflation and you're going to do okay. It's going to give you passive income. You guys, every fix and flip developing is all great. It gives you huge cash infusions, but it is a lot of work. Once you get these BRRRR properties or your apartments stabilized and you get good management on there, it's very passive. Most of our properties have been fully renovated. We've hit the systems, we've hit all the major items, we've good quality tenants. We don't have a lot of issues, and we get to constantly collect our passive income every month. And that's where it's going to get you to financial freedom. I know for me, I don't want to fix and flip properties for the rest of my life. I love flipping properties, but at the same time, it can drain you down, right? Like at one point, I remember in 2015, I had over 100 flips going at one time. That was a lot of work. I don't want to work that hard anymore. Uh, so, additional resources that we can help you with is 1031 exchanging. Myself and Will have done a ton of 1031 exchanging. We help our clients with it. We work with different partners that will help that as well. We can help you with self-directed IRA and 401k purchasing, get you referrals to that. If you have any questions about opportunity zones, we can talk about the tax benefits of that, why you'd want to do that, why you wouldn't want to do it, depending on what your investment goals are. And then if you're looking for a specific product, we have an off-market company with Buck Buys Houses that has been constantly talking to sellers for years, and we have a large database of additional opportunities that you won't see anywhere else. One thing that our team is very talented at is leverage and structure. So buying your rental properties isn't just about getting the best possible deal or the cash flow. It's about setting that deal up correctly to where you can leave as little money as possible in that deal so you have more gunpowder to go buy another and optimize and maximize out that return. The less money you have to leave in the deal, the higher return you're going to get, but you don't want to over leverage. So we can walk you through all those different types of scenarios. In addition to, for years, I stayed away from property management because it's a ton of work. But over the last year and a half, we have started a property management company for our clients that we have very low rates for our clients. It's around 7%, which is about 3 points lower than average. So if you buy a rental property with us, we can give you property management for a lot lower price. So who is our team? And you guys, we are expanding this team right now as well. So we have myself and Jen Hafner run the investments for the multifamily, the large and small. One thing about Jen is she is one of the hardest working people I know. She is going to help you through any types of transaction. If you're looking for that deal, she's going to find it out. And so what we're going to do is if you want to buy holding properties and you're interested in moving forward, we're going to have you come in. You're going to meet with Jen. She's going to go over your buy box, what your goals are going to be. And then she's going to help you make those selections and tell you where you should buy based on the returns and your long-term goals that you're trying to do. Our 1031 partner is Kyle Williams at Investment Property Exchange with Fidelity National Title. The reason we like him, he's super professional. And we know that Fidelity is always good for your money. It's not going to go anywhere if you give them. They have more money than all of us. Um, and our short-term financing partner at Heaton Dainard is Kyle Johnson at Intrust Funding. So they're going to help you with that BRRRR financing and the BRRRR financing and um, the original takedown financing. And that is really key, guys. When you want to buy that BRRRR property, it's really hard to get traditional financing on it. A, the seller's not going to give you the price you need because you have terms on it. B, most lenders, especially right now, are not going to want to finance some house that's all dilapidated. So how we do BRRRR properties is you set it up with a hard money loan. They're going to allow you to add in the construction amount into your loan. You're going to come in with a down payment, and then you can rate and term refi it, or even after a certain amount of time with seasoning, 6 to 12 months, you can get your cash back out and get most of your cash in because you bought a value add property. And then one of our financing partners is Jason Zhang at Caliber Home Loans, and we work with numerous different mortgage guys. Depending on what your situation is, we're going to get you the right guy. So why keep them? There is, trust me, I asked myself this numerous times. Why did I sell so many single family homes back in 2008, 9, and 10, not keep them all? The first thing is I didn't have the money to keep them all, so it was a non-option. But I wish I would have kept a few more because obviously they quadrupled in value. Um, so the reason why people keep them is because rents are up. King County is up 20.9% in 2022. Pierce County is up 22%, and Snohomish County is up 21%, not 51. Sorry, guys, that's a typo. So the rents have been climbing dramatically with housing costs. We have seen them cool down, but we have not, at least in our own portfolio, we're not seeing a whole lot of dipping. Where I have seen rents dropping in certain spots are more of those high-end luxury condos or luxury rentals. That has starting to compress a lot. But the meat and potatoes of what we're looking at typically are going to rent for anywhere between 1,500 and 2,000 a month. That stuff is still renting very well. I think we just went through our portfolio. Our occupancy rate is averaging anywhere between 95 and 96% occupied. So we're not having issues with getting our rents right now, even in today's market. And one thing that I do firmly believe is, because housing's got so expensive, rates have gotten so expensive, and now the FOMO of never owning a house is now over. People are getting comfortable with just being in a rental. Millennials, I mean, that's what we saw in 2008, 9, and 10. People were just okay renting. That's what we're going into. So stability in the rental market should be good. And the one thing that we want to point out, because we do look at these properties on a 5-10 year basis for you, is the average home appreciation for the last 20 years is 3.53%. So that's something that we're going to build into our metrics when we're showing you, we're not going to just show you the value of the property or the cash flow on the property. We're going to show you what that's going to look like if you keep it for a certain amount of time. In addition to, that's going to tell you when to kind of 1031 exchange out and get into more properties. And so that's a very important stat for us to look at, you guys. Appreciation that we've seen over the last, I've talked to a lot of investors over the last couple of years, and one big mistake that I hear them say often, and I can't call it a mistake because everyone needs to invest the way they want to invest, but to me, it's a mistake. They bought these single family homes in good neighborhoods like East Side, Seattle, and they went so far up in value that they're saying, well, these things just keep going in value. I'm never selling them. For me, if something goes up way up in value, I'm going to 1031 exchange it and trade that out for more doors. So, that's what we want to show you is where is your equity position. Your equity is how you grow your portfolio quickly. And so we're going to always look at that as you're looking at buying that next deal. So how do we get going? So the first thing we want to do is get you set up with a one-on-one strategy meeting. We want you to come in. We want to know what you own, what you don't own, where you're at in your buy process, and then what you're really trying to achieve as an investor. Is it you're trying to buy your first rental property and just start building your holdings? You want something clean and you just want something stable? Or do you want that BRRRR property that's going to get you that big equity position you're ready to put in work? Every investor is different on how they buy properties and which ones they keep. A lot of people would think I'm crazy for some of the stuff I keep, but I have it for a certain reason. That doesn't make it right or wrong. It's what works for me. So we want to sit down with you and figure out what that strategy is. We want to we want to look at your portfolio. If you own any properties, should you keep them? Should you trade them out? Or are you underperforming on your rents? So we should look at that. And then we want to put together like a quick snapshot of a 5-year and 10-year action plan. What do you own now, and how many doors are you trying to get to? What capital do you have, and how much passive income are you trying to get to? And those are key questions that we want to sit down and go with you and kind of build out that plan. We want to get you pre-qualified because there's no point in shopping, guys, unless you know you have the access to the money. And then we're going to start identifying opportunities. If you want to do a 1031 exchange with us, we're going to do the disposition. We're going to have a one-on-one strategy meeting with you. We're going to walk your property. We're going to look at your portfolio. We're going to put together a plan on how to upgrade you right now. We're going to get your 1031 set up. Your properties can get listed. We're going to locate that new investment. And then we are going to put you into a new deal and trade you out to get you a higher return. For any new investors that are in here, we do have a house hacking first-time home buyers program. Liam runs that for us, and he actually, how he got the job is he came in looking to house hack. We got him into his deal. We got him set up the financing. He fell in love with the process, and now for the last 2 years, he's been helping our clients get these deals. So the benefits to house hacking is with the first-time home buyer program, you live in the property, you can get a very low down payment, so you don't have to have a lot of cash to buy this deal. You get to subsidize your housing costs and save yourself the rent expense. And then you get into ownership. The negative is you got roommates, but there's multiple strategies for this. You can either live in it, you can do a split level duplex, you can rent by the room, you can do short-term rentals, you can do low down multifamily. I know Liam bought one of his first ones was a condo in Belltown. Now he lives there part-time, does short-term rentals when he's traveling, and it helps pay his money. So if you are a new investor and you are low on capital, then you can, Liam is your guy and we can get you situated. You don't always have to have 15 to 20% down. So there's two different approaches I want to talk about that we're going to really be looking at when we're looking at buying properties. There's traditional approach and the value add approach. The traditional approach is just something that's very simple. We're looking at a deal on existing financial metrics. We're going to look at, is it underperforming? Can we increase rents? Can we improve the management and increase it very naturally without having to do a ton of rehab work? You might have to do some carpet and paint and some small things, but not a lot of work. This is perfect for those full-time employees that don't want to get their hands dirty. And some people don't want to, and I don't blame them. Rehabbing is not that fun. But typically, it's going to require a little bit more cash because you're not going to walk into that massive equity position day one with the BRRRR style properties. On a 2 to 4 units, you're going to leave 10 to 20% in the deal. On 5 units above, you're going to leave 20 to 40% down. And the only reason I say 40% is like, you guys, if you want to buy on the east side, the metrics are so bad, but the location is so good. Typically, you have to put more money down because the bank's not going to cover you on the DCR rating. And so that's why I put in the 40. But typically on average with the 5 unit above, you're going to do 20, 25% down. Now with the value add approach, it's a lot different. We are going to target fix and flip style properties. Properties are heavily discounted that need a rehab plan to increase the value. So we're going to look at the performance metrics. What are you buying it for? What's the equity position? What kind of leverage can you stack in there? And are we under that threshold to where you can get most of your cash back out or leave a portion of it in? We're going to look at what's really important is the cost of improvements. What do you need to do to put into that house to improve the value to get it to appraise right? And typically it's going to have a 2-step loan process. You're going to take it down with hard money and you're going to refi it with a conforming lender. The benefits to BRRRRs, and you guys, that is how I got my whole portfolio built and is doing the hard work and building things out, is you get a much better leverage position. On your traditional, you're putting 20% down, whereas with a BRRRR, yes, I'm coming in with 15 to 20% down with a hard money lender, but when I go refinance, I get to use that new appraised value, and because I'm adding value by a rental plan, typically I'm going to have a 20 to 25% equity position, which I can then get leverage on. The negative of the BRRRR is this a lot longer stabilization period. On a traditional approach, when you buy that property with 20% down, you're getting income day one. There's tenants in there a lot of the times, or it's very easy to get a tenant back in there within 30 days. With a BRRRR property, the bigger the fixture, the better the deal. So it can take anywhere between 3, 6, 9, and sometimes even longer than 12 months to get these things fully stabilized. And so you don't get any income and you have to pay for it for that 6, 12-month period. So those are things to think about before you select what way you want to go. So investing with us. So you guys, with long-term holds, if you want, or if you don't want to buy a property, you don't want to manage it, you don't want to do the construction for a BRRRR property, you have cash there, or you have a self-directed IRA or something like that, and you want to invest in one of deals, you can go with syndicating as well. But you must be a accredited investor. It's going to give you passive income where you're just putting up the money and you're going to get a pref return plus an equity kick later down the road. And you're going to know your target IRR when you go into that deal. So syndicating is really for people that just don't want to do the work. They don't want to manage it. They don't want to hire the property manager, but you do have to be an accredited investor to do this. And then one extra bonus on the syndicate is you get that bonus depreciation when things are cost set down. So we're going to look at a single family rental BRRRR property that we actually sold to just recently. I think this is 90 days ago. So this is with the higher rates in there as well. So what it was a 2-bedroom, 1-bath property. So I call this a light BRRRR. We're getting a good discount on it, not as heavy as I would see on a major fixer, but we're getting a day one walk-in margin where we're buying this right. So it's a light fixer, 2 bedrooms, 1 bath, built in 1943. So it's got some older systems, but as you can see, like the roof was new, the windows have been updated. A lot of them had. 1943 usually has not knob and tube, but it's got like it has grounded wiring, but like cloth wrap wiring. So it's not new wiring, but it's not dangerous wiring. I do know the panel was outdated on this, and that was changed out. It sat on a 9,900 square foot lot, which you can actually build a dadu on later. So that's the big kicker on this deal. It was only 700 square feet, and it was just a cosmetic fixture. So what's the math look like? So on a flip deal, why did this look better for a BRRRR than a flip? You could purchase it for $350. We factored you were going to need to put $65 into the renovation and target a value of $499. That was only going to give you an estimated profit of 10 to 15 grand in that deal. Not a great flip. Not something I would buy right now. Total cash invested with Intrust Funding's construction loan would have been $83,000. So that's roughly a return of about 15%, or it's 12.5%. It's not a terrible return, but it's not good enough for this current flip market conditions, not with leverage. If you're all cash, it's a little bit different story. Now with a rental overview, so if I just looked at this very simple as an investor and passed on this as a flip, I might be missing the whole boat. As a rental overview, I'm paying $350 for this. I don't have to put $65 in to get it rent ready. I have to put $35 in. And then the value ends up being $475, not $499, because I'm not going to the same level as the $500,000 house. But why is this a good buy? After I'm done renovating this thing and getting it stabilized, I'm gonna have nearly $90,000 to $100,000 equity position that I can bank and use later to trade out for other buildings. So I like that kind of deal. I don't mind buying a property on slim cash flow if I'm making that 75 to 100 grand, because I'm gonna keep this for 1 year and a day, and I'm gonna trade that for a 2 to 4 unit later. And in that $100,000 is gonna come really in handy for my 20% down on that next 2 to 4 unit. And I can trade this one little 700 square foot house for a 4 unit with no more money out of my pocket. And that's why that's so key. So about getting these things built up in your portfolio, it can make a huge difference. And if I don't want to trade it out in a year and a day, I have other opportunities here. I will always buy something on a little slimmer cash flow if I have development upside. As you can see back here, there was access to this back lot back off this gate. You can go in and put a dadu in this backyard and build it and rent it out and then refi it, or build it, conduit, sell it, and keep the house, or build it, conduit, keep the rental in the back, and then sell the house in the front and take your basis down. So I like that there's versatility in the deal. So as you can see in the pictures, was really cosmetic, you guys. This is a great first-time rental property. You're buying something that's got a little bit of a discount. It doesn't need a lot of work. Like you can see, the vanities were cleaned up. It was just a property that was taken care of by a landlord. So just like we give you on the flip properties, we're going to give you a metrics behind the rental pro forma. So as you can see, we have $350,000 as the purchase price. We had the rental factored in there. The appraised value at $475, and then we factor in, as you can see in these two boxes, we factored in you're going to hold hard money for 4 months, 2 to renovate it and 2 to refi it during that time. And the reason that's important is because every time you make a hard money payment, that's a cost of the deal, and that's going to come out of your pocket, or it can be factored in, and you have to be looking at that when you're looking at that new appraised value. So as you can see, we had rents at $2,850 on this small little property. Well, we'll show you how we came up with those. And then we backed out all the property taxes, insurance, and different costs. Now, on single family homes, we don't factor in utilities. We don't factor in landscaping and those things in there. The reason being is because our tenant will pay all those. If we're buying an apartment building, we will be factoring all those in and then looking at either utility bill backs or just eating the cost in the pro forma. But as you can see in this number, this bottom yellow box is really important to look at. This gives you the key figures on this deal. So we knew that we could buy this property. It was going to bring in about $30,000 a year. The cap rate was a 7.8, and it was going to give us a cash flow position. Sorry, guys, I'm having problems reading because that the like little box above there. It's going to give you a cash on cash return of 4%. That is not great, you guys. 4% to me isn't like something I get excited about. Typically, I'm shooting for 10% on my returns on deals, but I can't get these cosmetic deals with a 10% return. And so it's kind of a trade-off, right? Like we can buy this, we can rehab it in 30 days, get teed up, pick up the $100,000 position, make a little bit of a cash flow on this property, and then bank it to sell it and trade it out later or build that dadu. I kind of skipped over this. So after all expenses, this property was only going to net about $199 a month. Now, these key figures will help you kind of look through a deal real quick. As you're an investor, one thing that you want to think about is what is your minimum cash on cash return for types of properties. I know typically for me, if I'm picking up something with a development upside, I'll look at a 5-6% cash on cash deal if I can leave a little bit of money in the deal. If it's a straight rental property, maybe outside the core metro areas, where there's nothing wrong with, and I'm tracing just pure cash flow, I'm shooting for 8 to 11%, depending on what the building is and location and type of neighborhood. So by knowing those things, I can look at a deal really quick with the key figures and go, yeah, this is for me or not for me. So narrow that buy box down. We will help you do all of that in the one-on-one when you get ready to go and get pre-qualified. So things to look at that are also important in this deal is what is going on with expense. So in this top box here, this is going to break down your hard money costs. So when the client bought this deal, they had to come up with $93,750 to get that, but that was also going to bank in the $35,000 in construction costs back to them. This tells them during that rehab period, the 4 months, it was going to cost them $6,500 to hold that property. In addition to, then we looked at, well, how much cash are you going to have to leave in this deal? So we factored that the client was going to be able to do 70% loan to value at 475, which was going to give them a loan balance of 335,000, which that allowed the investor to get back over 50% of their capital back once it was fully stabilized, or about 50% of the capital back. And they were leaving about 53 grand in the deal when it was all said and done. So that makes it, so they bought a property, they're picking up $100,000 in equity. They're going to leave 50 grand in that deal and make a 4% return. But the thing to think about is that's just in the now, short-term pain versus long-term pain. And, so what I'm looking at a lot right now is I'm chasing these development properties that have low cash on cash return. Again, this was at a 4% cash on cash. Estimated rent's $2,850, leaving 53 grand of the deal. I'm cash flowing $200 a month, and I'm making 4% on the money. But are we missing it? Hold on, guys, one sec. You know what? I was going too fast. I'll show you why I really like this deal in a second. So we're going to give you those key metrics. Does it hit your buy box? Then we're going to back up this deal with our rent comparables. We're going to always give you that with Northwest MLS comparables, whatever's going on in the market, and then rental meter we also use as a reference point. So as you can see, it was at 2,900, 26 was the average. So how did we come up with 2,850? Well, we also had a property that rented for 2,900 that was actually in a worse location than ours, not with the same size lot, but a little bit bigger, and it was rented by one of our own clients. So we felt really good at that 2,850, considering that they listed theirs for 2,800 and it rented for 29. So things, and this is what I'm talking about with the short-term pain. You guys, the reason I like this deal is this property came with $100,000 in equity. I'm going to trade later out or build a dadu. Yes, the cash flow sucks. 4%, not great. $200 a month. That's at a 7% interest rate, though. Look at what it does once rate falls. So, we actually, on the Bigger Pockets on the Market podcast today, we interviewed a couple analysts, and they're predicting that the rates are going to fall in Q4 to be in that roughly mid 5 range in there. And that's just in 1 year. I factored this on a 2-year basis. But if this deal, let's say it goes to 5.5% in 9 months and you refinance then, you're now going with your new monthly payment, your cash flow is going to go from $200 a month to $650 a month, and it's going to give you a 12% cash on cash return. If it goes down to 5, your return is going to go to 14%. And if it goes to 4.75, which we can see in about 2 years, it's going to go to a 15% return. So in 2 years, if I keep this deal, I'm making 15% cash on cash return. In addition to, as the rates fall, the value is going to increase. My $100,000 equity position is going to increase as well. And so what that's going to do is it's going to give me in the short term, in 9 months, I'm going to be able to get over a 10% threshold, which is a buy for me all day long, plus a development upside. In addition to, I can then trade that property later. So I'm not worried about the cash flow today. I'm really looking at where is it going to be at 9 to 12 months. And if a property has additional upside, it's a no-brainer buy. So other success stories that we've sold recently is in Seattle. We sold a fourplex for $800,000. The return was 10% cash on cash return, but it was expensive, good neighborhood. They had to leave 310 in the deal. And then we sold 2 fourplexes to one of our 1031 exchange clients recently. They paid $1.96 million for it. It's a 12% cash on cash return, but again, they have to leave $496 in that deal. And then we had a Bothell duplex that was a great buy. Actually, my cousins bought it randomly. They paid $462 for it. They're getting a 16% cash on cash return, and they had to leave $73,000 into it. I actually think they had that reappraised, and they got most of their money back out in the last 12 months. And so, because I do know finding a duplex in Bothell is nearly impossible. And so the purchase price of $462 was unheard of. But a 16% return on their investment, I don't mind leaving a little bit of cash in a deal if I'm making 16%. So average investments, your average savings is 0.5, average CDs 0.58. Our cash on cash return is we target 13 to 18% in a 6 to 9 month period. With leveraged investors, that turns into 30 to 55%. So we're shooting for a lot higher. So what's next steps if you want to work with Heaton Dainard? We'll get you guys into the office. Again, I apologize for the snow. Bad timing, but snow was fun. So if you want to move forward with us and come in for a one-on-one and meet with us, we need you to complete the survey. You're going to be emailed this right after the class. The concierge Liam is going to reach out to you and talk to you about what your goals are, kind of get you figured out when a good time for you to come in. We're going to schedule that one-on-one time with the broker after Liam has that conversation. We're going to get you pre-qualified, and then we're going to get you into that next deal. So for more information, if you want more information about us and how we do business, go to HeatonDainard.com or Instagram at Heaton Dainard and Facebook Heaton Dainard. For more free fix and flip tips, buying strategies, check me out on J Dane Flips or on Project RE's YouTube. You guys, we do a lot of instructional videos, and these aren't the generic ones that everyone's going to talk about how you get rich in real estate. We go through a lot of granular stuff, like what are we doing in the project, we go through tangible things that you need to work on your project. So definitely check those out. And also don't forget to check us out on the Market podcast with Bigger Pockets. I know we just released a lot of great episodes. It's one of the fastest growing podcasts in the real estate space right now. So, but we go through all the trends of what you should be looking for. And you guys, that's really going to help you guys down the road, like going through forecasting. What are we seeing in the trends? What are we doing to pivot our own businesses? So make sure you check that out as well. And for more free education on construction, go to HeatonDainard.com, Investor Corner, and we have a 4-part construction series, guys, that really breaks down a lot of different questions and answers. So Liam will be reaching out afterwards. And now what we're going to do is we're going to dive into Intrust funding. Now, Kyle got stuck on the road with the snow, so I am going to be filling in for Kyle. So Kyle Johnson is actually he's the manager of Intrust funding or senior loan professional. He'll be handling a lot of questions. He'll be reaching out to you as well, but I'm going to take you through the basics of hard money, and then we are going to open up for questions, you guys. And again, fire questions in there. I see some already in the chat box. I will answer those. So what we're going to talk about with the Intrust funding, you guys, now that we talked about Heaton Dainard, how to find a good deal, we have our sister company, Intrust Funding. They are separate businesses. So you do not have to use Intrust funding to buy one of our properties, even though it does make it easier and moves faster. We can't, if this happens quite a bit, investor will commit to a deal. They have some other money, and then all of a sudden their money gets shaky because they got to do an appraisal. Intrust funding does no appraisals, and then the deal gets messed up. And if that happens, the earnest money you brought in is lost. We can't be accountable for another lender, but what we do know is we can fund every one of your deals and any deal that you want. Intrust funding prides themselves on being very easy. If you ask around, we are very easy lenders to work with compared to a lot of other ones. So let's just kind of dive into this. This is actually my first time teaching this presentation, but I think I know it well. So Intrust funding, is a local hard money real estate company, you guys. They are not exclusive to Heaton Dainard. You guys, many times are people I know outbid me on market deals at the auction or even on off market deals with Intrust Funding's money, which is totally okay. They're separate businesses. They do not work. They work together. We have similar ownerships, but not the same. But they are do stand on their own, so you don't ever have to worry about that. Call Interest Funding to fund any deal. It doesn't have to be Heaton Dainard. So with interest funding, though, we are faster than normal. We will get you a loan approval within 48 hours. Um, Everything is reviewed in-house by us. We don't use appraisals. We don't do draw inspections. We are the guys making the decisions. We're the ones putting the values on the property. So a lot of so-called hard money lenders, you know what? I call them soft money lenders. They have different terms. They have a little bit lower rates, but they come with all different types of hassles, right? Because it's really hard money and bank financing all mixed into one. And as the market's cooled down, guess what? The rates have also skyrocketed, and a lot of them have just gone away because they can't deal with the appraisals. So that we have no contingencies. Once we give you that approval, we can get that funded. If you have that good buy, we can fund that deal in 48 hours. And then we can do any type of loan size, and we will also do construction loans with anywhere between a 15 to 20% down payment in there. So the loan process, to walk you guys through it. So Kyle Johnson, who usually teaches this class, he's going to reach out to you guys, talk to you guys, get you guys pre-qualified. The pre-qualification is super simple. It's light, and he's going to figure out what your kind of properties you're looking for, location. Um, Once you guys get pre-qualified, you're going to submit a deal to him. It's going to be underwritten by Sean, who's worked with us for years. Sean is a pro underwriter. He has worked for big hedge funds, underwriting a lot of rental acquisitions. He knows how to do it quickly, and he can really look at that deal. And you guys, when they're looking at that deal too, it's kind of like a free look from us as well. If you have an off-market deal, we're going to give you honest feedback. If Intrust Funding or Sean asks you to put down more money, probably not a good buy, because it's all based on loan to value. So always take what they say very seriously. We will fund the deal no matter what. But, we are also trying to be helpful with you guys. We want you to be long-term clients. We don't want you buying a bad deal. Will is my business partner, he's the shot caller. So he handles all the investor relations and does final underwriting with Sean. And then Amanda, who is amazing, has worked with us for nearly 10 years as well. She worked at Heaton Dainard for years, and now she's our operations manager at Intrust Funding. She has a vast background in lending documents, and she can break down any type of note and deed of trust for you that you need. In addition to, she's a machine on cranking out loan docs. So if you got a quick deal to do, we will get your docs to escrow. So what is hard money? Hard money, the purpose of hard money is it's expensive. Let's talk about what hard money. Let's summarize real quick. It's expensive, but it's fast and easy, and it's a cost to the deal. The first property I ever bought outside of a piece of land I bought when I was 19. The first house I bought with hard money. I didn't even really know about rates and terms and kind of what that meant at that time, but I paid a lot. It was 12 to 18% back then, 2 to 4 points. But the purpose is I had a really good buy. I was buying something 50, 60 cents on the dollar that was not financeable. And the only way for me to get into that deal was an opportunity cost of getting a bridge loan and to get it stabilized. Regular banks don't like financing on dilapidated homes. So what it did is allow me to get into the deals. So hard money is set up for short-term loans. It is not a permanent deal. Typically, people use it for 6 to 12 months at a time. It is interest only. So it is a cost against your deal directly, and you need to account for that in your pro forma. The beautiful thing about hard money is you can get increased leverage, right? With a traditional lender, you're going to put 20% down, come up with your rehab out of pocket, whereas interest funding will wrap that all into one loan and financing your construction costs and get it stabilized. And it's funded by local investors inside of our fund and ourselves as well. So what is the advantages of interest hard money? So the first thing is you guys, again, there's a lot of people out there. I call them soft money guys. They're floating around the market. They're going to say, hey, I can give you a lower rate. I can give you a low rate. I can fund it in 5 to 7 days. And that might be really 2 weeks. And then also they need an appraisal because they can't put their own value on it. Those are things that that is not true hard money. Hard money are guys that evaluate the asset. They value it. They look at the loan to value and they fund that deal, right? So we don't do appraisals. We don't do BPOs. We make the calls ourselves, and we fund everything in-house, and we make all of our own calls. We require 15 pictures of the property. That's it. We don't take appraisals. We want to put our own value on it. And we can close your deal in as little as 48 hours. So if you have a deal that's going sideways for whatever reason, we can step in and fund it. We've actually, sorry guys, cold season. So we can we've done this numerous times for 1031 exchange, guys. Guys get a jam, they got to fund their deal. We'll step in and fund them for 2 to 3 weeks, and then they refi us out. So it's the purpose of hard money is speed and to use leverage with construction. All fees are combined in loans, so you will not pay your points or fees. They are rolled into the loan. You don't pay them up front. Watch out for that with any other hard money lender. A lot of times they want you to bring that up front in. So they may be a little bit less down, but they want fees and points and appraisal fees up front, and it ends up being very, very similar at the end of the day. And then in addition to our major hard money is when we do rehab construction loans is you get your check. Once you fund that deal and you want to get started, we're going to get you that check right away to get you started. Most hard money lenders want to be reimbursed, right? So if you buy that deal and let's say they give you 100 grand as the construction fund holdback, you got to come up with the first 20, get it done, and they're going to reimburse you. Whereas we're going to give you that first 20 right away to get going. We want you to get in and out of these deals as quickly as possible. You struggling with cash is no good for us as a lender too. We're your partner. We want you to get this deal done. We want to be able to get this loan paid off, and we want to finance you on the next deal. So again, the biggest deal is, and you guys watch for this too, like on hard money loan terms, like right now, you guys, if we're at 20% down, you'll hear some lenders say, well, we're 15%, but then they're not funding you that first construction draw up front. So you're essentially putting 20% down, right? If you have $100 grand deal, because you're still coming up with the additional capital right after closing. So it's really just a way to kind of move the numbers around. So ask all those important questions when you're talking to a true hard money guy. So loan options. There's kind of 2 different loans that we do. You guys, we can finance you on anything. The standard is a purchase loan, and the other one is a rehab loan. So let's kind of break those down. A standard loan is where you're going to put down anywhere between 15 to 20% down. We're going to give you a 5 to 12 month loan term. There is no prepays. Loan fees start at 2 points, and then we will go up to a 70% loan to ARV. And so, some of our clients, sometimes they have half the cash and they will have us fund 50% of the deals. So this is more just for when you need a little bit of extra cash. What majority of people use hard money for is for leverage, how to maximize that pot of money that you have. Again, like I talked about Heaton Dainard, if I got 100 grand sitting there and I can make a 25% return deal with hard money in a construction loan or a 15% return deal by paying all cash, I'd rather go do 2 and double up my pot of money, because as an investor, my whole job is to grow this pot. So then I can passively invest it and live off that, but I need it to be a certain size. So rehab loans help you maximize your velocity of money. So what the rehab loan is, it's where the purchase price and the rehab amount are made into one loan. It's the total project cost. Your payments can be 15 to 20% down. The points in the rehab are rolled into that loan. The standard term is 5 to 12 months. There is no prepayment penalties. And again, it's the same rate and terms, or same terms, around 2% and a 70% loan to value. So the biggest difference is you're just borrowing more at that point, but you can put less down. And you guys, we don't have construction draw people. Like, that's another thing that I hear a lot of complaints about is, when you're working on your project, you want your money, and the draws are a big deal. So, we're going to talk about how we break this down for you. We don't send a third party out to go look at the projects. I know a lot of lenders in town, they like hire a third party and they go inspect their property and they're going to give you a report back. Then that report might not say what you think it is. And then all of a sudden you're stalled out on your money. So that can be detrimental to your liquidity during a lot of projects. So what we do is we give you 20%, like on a $60,000 rehab plan, we're going to give you $20,000 to get you going on that project. The second draw is going to be 25% of the balance, which is 10,000. The third draw is 10,000, which is you're now at 50%. And the fourth draw is at 75%. And once you're all said and done with the project, we're going to give you 100% of the total amount. But we're going to keep you going the whole way. And how you get those draws is you fill out our form. It's simple, right? You don't have a third party go out there. You fill out what's been done, what hasn't been done. And then you send us 15 pictures of the project. we're going to look at those pictures. And if we have questions, we might drive out there and look at it, but it's not third party, it's us. Or we might ask for more photos, but then we're going to get you that check very quickly after that. So again, no delays on that. So let's look at the different examples of a standard rehab or standard deal versus a rehab. So on a standard loan, if the client's paying 650,000, they're going to put 20% down. So let's say it's 130 grand down. They're going to come up with the rehab of 160,000 for this specific project. And their cash out of pocket on this deal is going to be about $290,000. So the benefit to that is they're only going to be paying because interest funding charges 1% a month or 12% annually. So they're going to be paying on a much lower loan amount at that point because you're at 650 minus 130, so you're at 520. So your payment is $5,200 a month. Now, if you do a rehab loan, it's 650 plus the 160 in. That's a total loan amount of 810 with 20% down. You're bringing in 162. Now, remember, that's as much as the rehab was on this other side. Your monthly interest payment on that's going to be 1% a month. So at the end of the day, you're 810 minus 162. That's going to give you about, your payment's going to be roughly about, what is that, 7? Sorry, guys, I don't have a calculator from me. That is 8, 7. It's going to be roughly about 630,000. So your payment's going to be about 630 a month. So, so you do increase your debt cost, but your cash out of pocket goes down substantially. And so as an investor, you just got to pick about what you do. We can do either one. We can finance you 50% down, whatever you want to do. We can definitely work with it. Most of our clients do the rehab loan. So let's look at a deal that we recently funded. So the loan amount was 721. The strategy was flip. The ARV was $1 million. Sold price was 135. So this is a loan that we just funded recently. Was that Andy again? Andy, your properties are just keep making it. That's because you're a good client. Actually, you guys, Andy's house, Andy likes us so much, he came to our 101 class just to hang out. And he had 2 properties in here he had good experiences with. Actually, what he did just say is that house was brutal. It was a tough rehab plan, I think. But, Andy, it taught you a lot of lessons about rehabbing. So now it just makes you a better investor. This was a project that I typically like to buy. Full rebuild, full broke down. And then he follows up with, haha, that one made me a lot of money. And he likes to complain. He likes to complain on the way out the door, but then he's happy when it closes. So, yeah, you guys, and going back to his point, it was a lot of work, right? So here's the breakdown on it. 650, 160 with $1 million resale. Now, I do know he went over budget, and we also crushed the value and went up to 1.3. That wasn't just because of the market. That was also because he really did do a great job on the property. And so you can see how this kind of works down. So like on this example, we have you can see the 650, 160, and $1 million. Just like we talked about Heaton Dainard, this shows you the different cash on cash returns. So same expenses backed out as what we talked about earlier. And then cash, you would net out 14%. On hard money with a 20% down loan, and that's where you're coming up on the 16%, you're coming up with 810,000. On the 20% down loan, you're coming up with 318,000, which is getting you a 23% return, which is a great return. But on the rehab loan, you're coming up with substantially less money because you're coming up, sorry guys, I can't really see this, 196, and the return ends up being 32% on this basis. So as you can see, the leverage worked in smart. And now he did a lot better on this deal because because he put the right plan on it, he sold it for a lot more money. But going in, right, he picked the rehab plan because he's making 13 points more on his cash, and it's saving him 50% of his cash that he can then redeploy in a different property. If he's making 16% more on both those properties, he's going to exponentially grow as an investor. So that's what Intrust Funding does. We help you get leverage. So for more information on Intrust Funding, reach out to Kyle directly at Kyle@Intrust Funding. And he will also be reaching out to you after this class, or check us out at intrustfunding.com. And we can sit down and go over different types of loan terms for you guys. But again, you guys, Intrust Funding is set to help you get your deals funded, help you as an investor. We will fund any type of deal. In addition to make it easy on yourself, you guys. Right now, I think our rates are very similar to almost everybody's. For a while, that bank financing was floating around in the 7, 8%. That era's gone, guys. That was never a real thing. That was just banks hiding in the hard money space. And so now, I know there's guys that are probably just a little bit cheaper than us, but ask them about their draws. Ask them about how do they get reimbursed? What is that process? Who makes those calls? You want to get money from people that make the calls. You don't want to get money from someone that's brokering the money that doesn't make the calls. That can lead to a disaster down the road. So now what we're going to do, guys, I want to thank everyone for coming out. We're going to open it up for questions. And I'm going to start rattling through the answers. I will stay on as long as the questions keep coming on. If once the questions end, we will call it a night, and I will let you guys sit by the fire in a snowy night. All right. So, just saw this. Some of us are at the door here. I am so sorry for anybody that showed up tonight. We really just didn't want people out driving in the snow. I was definitely ready to go. It for us as employers too. We don't want our employees there when it's icy. What's up, Tuna? Give me a shout. Andy did say L&I is not fun. That is true, you guys. Make sure you get your permits. You don't want to deal with unpermitted L&I stuff. Not fun. Andy asked a question. Are you paying someone to do cost segregations through a company or doing them online? Or only on the bigger buildings? That's a great question. So we only, and I do have some clients that cost seg with single family houses, and they do it online through a form. We don't do that. We only pay to have our larger buildings cost segged out. Typically, it's going to be about 15 units or above at that point. That kind of justifies the cost. It costs us around $2,500 to do a building. We got 3 going on right now. I can confirm that pricing, and I'll post it on my social media. But yeah, we stick to bigger ones so we can get the big benefit. One of our clients does do it online. It costs him nothing. I don't. He's I just get worried about we like to make sure our books are very, very clean. So we don't like to self-perform that. Dash asks, can you get a copy of that Excel sheet? That is really for our clients. We will be putting these up. You know what? Go to jamesdainard.com in about a month, and all these forms will be on there. Andy asks, what financing do you use on these properties that take you 12 months? Typically, I got one right now with interest funding that's going over 12 months. The most important thing to do, guys, when you're talking to any hard money lender, they might have terms, a lot of them are going to come out with 6, 9 month terms, maybe 12. But you want to talk to them and say, hey, look, I got a longer project. This is why I like the deal. Long project usually means complex too. So you want to make sure that they know that you can get through this project. And then do yourself a favor and negotiate your points and terms up front. If you get the end of your term, you're going to have to pay extension fees. And if you don't negotiate that longer term up front, you're going to end up paying more points and interest down the road. So, many, many times, like with interest funding, even, we negotiated a certain amount of points for a 15-month loan. And you guys, yes, I'm a principal in interest funding, but I can tell you we get no breaks on interest funding. The reason being is I can't give myself a break because we manage the fund. So we pay the highest interest and the highest points that everyone does. So, you just have to account for it in the deal, but talk to them up front. Don't just get your deal funded. Say, hey, this is what I'm doing. Here's the plan. I'm going to go this long. I want to be successful. I want you to be my partner and be successful in it. And, and just talk to them. And then that lender, like with interest funding, we're going to work that out with you because we want you to do the loan. We want you to do the project, but we want to make sure you're smart about it. It doesn't do us any good for you to be sucking wind on that project. So, make sure that you negotiate up front. Oh, look at Andy says interest is the best for construction loans. I 100% agree on that. I don't think anyone is wow, look at Tuna's shout out, made it onto the page. I don't think anyone's better than us guys on the construction process. And I'm not just saying that because I own the company or own part of it. We really do make it easy. I have done construction draws with big institutional people on like our really big flips. or like our huge apartment deals, it is not the same. You guys, we're constantly trying to get reimbursed our cash. I know, like on our big apartment deals, we had to like get reimbursed, a couple 100,000. Like it takes time with these companies, right? They're cheaper for a reason that they're slower. So just make sure you do those things. Okay. Any more questions, guys? This is the light on the questions. Again, you guys, I'm sorry for not coming to the meeting. Anyone that wanted to come meet in person, we will be doing one at the beginning of the year, right after New Year's. Um, and uh, I'll be there and we can all hang out and talk shop too. I know, I honestly, guys, I hate Zoom just like everyone. I like meeting people. I'm a people person. Uh, I like sitting down and talking to people. Gig Harbor Sue says, can I reach out to you privately tomorrow afternoon? Um, Yes, shoot me a message on Instagram and we'll try it depending on what I do have. Yes, I gotta be conscious with my schedule. I have a lot of meetings set for tomorrow. But yes, if you guys, the best way for random questions to get a hold of me, guys, we do respond to social media. We get so many questions in that's hang out and just fire out answers. Plus, we try to post them, buddy. So make sure that definitely hit um, he- go to J Dane Flips and send me a message, and we will get back to you. And yes, one of the wholesaling classes, they're coming soon. We are working on the class, and it's so the problem with me is I'm a deal guy, so I'm always trying to get deals done and keep the wheels going so our clients have a good experience. These classes take a long time to make. Not only that, I need some help putting them on. So but yes, you guys, we're hoping first quarter we're going to be going over a few different courses that will be available on Project RE, totally separate from Heaton Dainard and interest funding. Any more questions, guys? It can be about whatever. If you got any problems going on, we can talk about it, or positives. You guys got any wins? We like talking wins better than negatives. Okay, looks like the questions are slowing down. So I'm going to let you guys go. Enjoy the snow. If you have kids, go play in the snow. Sit by a fire. I don't know what just happened there, but something just kind of buzzed in my ears. But anyways, I want to thank everyone for coming out. And again, once you receive that survey, the best way to sit down and talk to us is fill out that survey. We'll reach out to you, get you in the office, and we will get you going on your investing career. And again, don't forget to check out the On the Market podcast at Bigger Pockets.